The air in the financial capitals of the world is currently thick with an unspoken tension, a quiet dread masking itself behind the facade of stabilized indices and optimistic earnings reports. We are living through a historical anomaly, a period where the traditional laws of economic gravity seem to have been suspended. This is not merely a housing bubble like 2008, nor is it a dot-com frenzy like 2000. This is the everything bubble. For over a decade, the global economy has been fueled by a relentless injection of liquidity. Central banks, led by the Federal Reserve, have expanded their balance sheets to unprecedented levels, suppressing interest rates to near zero in a desperate bid to stimulate growth. This tsunami of cheap capital had to go somewhere. It didn't just flow into productive factories or wages, it spilled over into every asset class imaginable. Real estate, speculative tech stocks, corporate bonds, and riskier alternative investments, everything rose in unison, decoupled from fundamental reality. But now, the music is stopping. As inflation forces interest rates higher, the easy money that sustained these valuations is evaporating. We are beginning to see the early tremors, sudden spikes in bond market volatility, widening spreads in credit default swaps, and the fragile liquidity that vanishes exactly when it is needed most. The buffer is gone, and we are standing on the precipice of a structural reckoning. The cracks in the facade are no longer microscopic, they're widening into visible chasms. The most alarming signal is the inverted yield curve, a historical predictor of recession with a near-perfect track record. When short-term treasury yields exceed long-term yields, the market is effectively betting against the future economy. Alongside this, we see the liquidity illusion. Markets appear deep and robust until stress hits, at which point buyers vanish, causing flash crashes in assets previously deemed safe. We must also examine the shadow banking sector and the realm of private credit, where trillions of dollars in loans exist outside the regulatory scrutiny of traditional banks. As interest rates remain elevated, the cost of servicing this debt skyrockets. Zombie companies, corporations that cannot cover interest payments with operating profits, are beginning to falter. In the housing market, while prices remain sticky, transaction volumes have plummeted, freezing the market in a state of suspended animation. The era of free money masked these structural weaknesses. The era of tight money is ruthlessly exposing them. The indicators are blinking red, suggesting the system is far more fragile than policymakers admit. To understand the severity of the impending correction, we must look under the hood at the mechanics of leverage. A stable economy relies on cash flow. A bubble economy relies on asset appreciation. When the cost of borrowing money is near zero, financial institutions and corporations load up on debt to buy assets, using those very assets as collateral. This works beautifully on the way up, but leverage is a double-edged sword. As the Federal Reserve tightens liquidity, asset prices inevitably correct. When the value of collateral falls, it triggers margin calls, demands for immediate cash that force investors to sell assets at any price. This forced selling drives prices down further, triggering more margin calls in a catastrophic feedback loop. This is the Minsky moment. Complicating this is the opaque world of derivatives and credit default swaps. These financial instruments, intended to hedge risk, often amplify it by linking the fate of massive institutions together. If one domino falls, a major hedge fund or a systemic bank, the counterparty risk spreads instantly through the global nervous system. We are not just dealing with market fluctuation, we are dealing with the mechanical unwinding of a decade's worth of artificial stability. To understand the magnitude of the current risk, we must look beyond American borders at the history of sovereign fragility. The pattern of the everything bubble is not unique. It echoes the structural failures seen in the Asian financial crisis of 1997. Back then, the tiger economies were the darlings of global growth, fueled by hot money and foreign-denominated debt. When liquidity tightened, capital fled, triggering a crisis that toppled currencies and regimes overnight. It proved that when leverage unwinds, it does so violently. We see darker parallels in the economic tragedies of Venezuela and Argentina. While extreme, they illustrate the endgame of fiscal dominance, where a central bank loses its independence and prints money solely to fund government spending. The result is always the same: currency collapse and the annihilation of middle-class savings. Even advanced economies are not immune. The Greek debt crisis showed that market sentiment can turn against a developed nation in weeks, sending bond yields vertical. The United States relies on the exorbitant privilege of the dollar to avoid these fates, exporting its inflation to the world. But as we witness instability in the British gilt market or the Japanese yen, the message is clear: no economy is too big to fail if it ignores the fundamental laws of solvency. The shockwaves of this global unwinding are now hitting the American shoreline with undeniable force. The everything bubble created a temporary wealth effect where soaring stock portfolios and inflated home values made consumers feel richer, driving distinct spending habits. Now, the reverse wealth effect is taking hold. As retirement accounts shrink and home equity stalls, the American consumer, the single largest engine of the global economy, is retreating. The housing market stands at ground zero of this domestic shift. With mortgage rates climbing to multi-decade highs, affordability has collapsed to record lows. Potential buyers are trapped in the rental market, while current homeowners are locked in by their existing low-rate mortgages, effectively freezing inventory. This paralysis bleeds outward. Fewer home sales mean a sharp decline in demand for renovations, durable goods, and construction labor. Simultaneously, corporate America faces a massive refinancing wall. Trillions of dollars in corporate debt, accrued when capital was virtually free, must soon be rolled over at punitive interest rates. This mathematical reality forces difficult choices: capital expenditure cuts, hiring freezes, and inevitably, layoffs. The labor market, always a lagging indicator, is the final domino to fall. Caught between persistent inflation eroding real wages and the looming threat of recession, the middle class faces a squeeze that threatens to erase a decade of economic gains. The Federal Reserve now finds itself trapped in a historical bind, navigating a treacherous path between two disastrous outcomes. For decades, the market operated under the assumption of the Fed put, the unshakable belief that the central bank would intervene to rescue asset prices whenever volatility spiked. That safety net is now effectively gone. Jerome Powell faces a binary choice: prioritize the fight against inflation or pivot to save the financial system from collapse. They cannot do both. If they cut rates to bail out the banking sector or stabilize the housing market, they risk entrenching inflation, leading to a 1970s-style stagflationary decade. If they hold the line to restore price stability, they risk detonating the debt bomb they helped create, potentially forcing a severe recession. This dilemma is exacerbated by the fiscal situation in Washington. The federal government is running massive deficits, yet the cost of servicing the national debt is exploding as interest rates rise. Interest payments on U.S. debt are on track to exceed the defense budget. This creates a vicious cycle. The government needs to borrow more to pay interest, but borrowing more drives yields higher. The tools that worked in 2008 and 2020, quantitative easing and zero interest rates, are arguably the poison, not the cure, in the current environment. The policymakers are running out of ammunition. In an economic environment where the tide is relentlessly going out, the most valuable asset is no longer a speculative growth stock or a leveraged property. It is liquidity. The era of passive income and easy appreciation is over. The era of capital preservation has begun. For the individual, the survival strategy must shift from offense to defense. This begins with the aggressive elimination of variable rate debt. In a high-interest regime, carrying credit card balances or adjustable-rate loans is financial suicide. Next, one must reevaluate the concept of safety. Cash, often derided as trash during the boom, regains its throne as the ultimate option value, granting you the ability to buy distressed assets when others are forced to sell. But the most critical hedge against the popping of the everything bubble is not financial, but human capital. When asset prices deflate, your ability to generate income through labor and skill becomes your primary engine of wealth. Job security is no longer guaranteed by tenure, but by indispensability. Diversifying income streams is not just a luxury, it is a structural necessity. The winners of the coming decade will not be those who leveraged the most, but those who maintained the discipline to stay solvent while the illusion of wealth evaporated around them. As the dust settles on the everything bubble, we will likely find ourselves in a landscape that looks fundamentally different from the last decade. The era of free money was a sedative that allowed us to ignore structural rot, widening inequality, and declining productivity. The withdrawal of that sedative is painful, chaotic, and terrifying, but it is also necessary. History teaches us that bubbles are not merely financial accidents, they are mechanisms of wealth transfer, and ultimately, reality checks. The market is a harsh disciplinarian, returning value to where it truly belongs, away from financial engineering and back toward genuine innovation, production, and savings. The correction we are witnessing is the system's immune response, purging the excesses of a distorted timeline. We may see a smaller economy in nominal terms, but perhaps a healthier one in structural terms. The question is not whether the bubble will fully burst. That process is already in motion. The question is what we will build on the foundation that remains. The party is over, the bill has arrived, and for the first time in a generation, the price of money is real. This is not the end of the American economy, but it is certainly the end of the illusion. The collapse of the everything bubble is not a spectator sport. It is a reality that demands engagement. We have laid out the data, the history, and the warning signs, but the most important variable in this equation is your response. This discussion should not end when the screen goes black. We want to hear from you. Are you seeing the signs of this correction in your local economy? Have high interest rates or inflation altered your personal strategy? Share your observations in the comments below. Crowdsourcing this information helps us all see the picture more clearly. If you found value in this deep dive and want to navigate the coming economic turbulence with clarity rather than fear, make sure you are subscribed. We are already researching our next documentary, which will expose the specific sectors most likely to crash next and the few safe havens left. You cannot afford to miss that analysis. Until then, stay skeptical, stay liquid, and stay prepared.